Hi, I'm Paul Merriman, and welcome to one of the many parts to a series called Bootcamp. In this series, the idea is to take you up to a fork in the road, and there really are only a handful of them, and help you decide whether you should be all in equities or all in fixed income or some combination. Decide whether you should be in individual stocks or maybe you want to be in a mutual fund and maybe you want to be in an index fund instead of an actively managed funds. Every one of those forks in the road have an impact on what you end up making at the end of your lifetime of investing. Our hope is that we can help you make better decisions. Some of these forks in the road can be just a tiny bit complex. And maybe that could be said about the one I want to talk about today. And we talk about it under the umbrella topic of the ultimate buy and hold portfolio. Now, we started talking about this and writing about it and podcasting about it in about 1995. And point that we made back then is basically the same that we make today. And that is one, there are a number of equity asset classes that, according to the academics, qualify. And there are a whole bunch of different ways you can put them together. But what I wanted to do when I did this originally in 1995, I wanted to make the case that by diversification of equity asset classes, you might not only be able to make a better rate of return, but you may make that extra rate of return without taking any more risk. And when we first did it, it was not the idea of building an all equity portfolio, as I'll talk about today. What we did back then was we took the position, wouldn't it be nice to get the returns of the S&P 500 and take 40% less risk? And what we showed them was a 60% equity and 40% fixed income portfolio, and the 60% equity portion was divided into tenths. So it was 10 6% positions. And then, of course, the fixed income. And at the end of the day, we showed them the return was about the same, whether you invested in the S&P 500 or you invested in the 10 equity asset classes plus 40% fixed income. Now, today, if we did that study, it would be about 30% or 35% fixed income. But why we changed and went all equity is because what people were hearing when I called it the ultimate buy and hold strategy, which, by the way, was really, I don't mean that it was tongue in cheek, but there's no way that I know what the ultimate is in terms of a buy and hold strategy. I just wanted to show the implications of all equity diversified over 10 different equity asset classes and what that return was compared to the S&P 500. But I didn't think people would get it if I just said, if you put your money in the S&P 500, you got X. And if you invested in 10 different equity asset classes, you would have gotten X plus. I'm not sure people would have believed it. I'm not sure people would have believed how the little changes in this portfolio as I go along will show you how unique this whole idea of diversification can be. We all believe in it when it comes, I say all, most of us believe in it. When it comes to investing in the S&P 500, we want to have 500 companies and we don't want to bet on any one. It might be Enron. On the other hand, in the portfolio that I'm going to show you today, there could be as many as 12,000 different companies in that portfolio. And that diversification pays off royally, as you will see. So now I'm going to take you to the first PowerPoint where I am going to show you the ultimate buy and hold portfolio, one tiny step at a time. So here we are, table A1A. And I want to just tell you what's on this page. You'll see we have three actual tables here, and I want to actually start at the one at the bottom. And I want you to notice that in this portfolio, we are going to be picking from these 10 different equity asset classes. Now, we're going to keep this simple here, and in essence, take a position in each of those asset classes. But we're going to start in what we'll call portfolio one. I'm not recommending this as a portfolio for you, although lots of people have that as their portfolio. Then when we move to portfolio two, we're going to have large cap value added, 10%. Then small cap blend. By the way, the S&P 500 is a blend of growth and value, even though it's the growth that drives it. As we know from the big seven companies, last year represented 53% of the rise in the S&P 500. It's growth. In the large cap value, you've gotten rid of the growth and you're living with just value in that particular equity asset class. Those companies are 100 billion and up in most cases. They're big companies. When we get to the small cap blend, SCB, it too is a combination of growth and value, but they're tinier companies. They're 3, 4, 5, $6 billion in capitalization. In other words, if you multiplied the number of shares times the price in the market, that would be the worth of those companies. They're much, much smaller companies. They're more risky companies for a long list of reasons. And as we know from discussions of this topic before, that the small cap companies make more money, and you'll see that at work here. Then we're going to add small cap value. It is the if you want to call an equity asset class the gold ring, historically that is where the highest returns have been. Small cap value. Get rid of the small growth companies and only hold those small companies that are, for some reason, out of favor. Sell for lower PE ratios or sell for a higher book to market ratio. Then we go to the REITs, real estate investment trusts. Then we add international large cap blend, international large cap value, international small cap blend, international small cap value, and emerging markets. So if we just wanted to go to the bottom line, if that's what we wanted, I would look at this table up here on the top, and I would say, okay, in portfolio one, we had the S&P 500. How did $100,000? What did it become? It became worth almost 30 million. On the other hand, if what we did was we put 10%, as we did way down here in portfolio 7, 10% in each one of them, we could look back here and see that it turned out to be worth $53 million. And you would say, okay, I'm ready to go. That's what I would like. But I want you to see what happens in between, going from 10.9 to 12.1%. It feels almost like magic when you look at it that way. But when you see it step by step, I think it's a different animal. So let's look at doing this step by step. Let's start with the $100,000 that grew to 29,851,000 in the S&P 500. And let's go to portfolio two. Remember, portfolio two meant we add 10%, a little bit, a baby step, I mean, literally a baby step in terms of risk, with 90% still in the S&P 500. And instead of 10.9% compound rate of return, it was 11.1. Now, I know 0.2% doesn't sound like a big deal. If your neighbor got 11.1 and you got 10.9, you might not even think there's really any difference. But I want you to see that over this 55-year period, that the difference was $2.259 million. That is a big difference for a little tiny piece of this equity asset class. And by the way, I think it's kind of important to note that 10.9% compound rate of return, the average of all 40-year periods starting in 1928 is 11. So the S&P 500 during this last 55 years has gotten what is basically the average, almost the average of the 40-year experience historically. Now, there have been some that have been higher and some that have been lower. The highest was 12.5, the lowest was 8.9. But this is close to the average. And by the way, we have this standard deviation measure here, which is simply a measure of volatility. It's measuring upside volatility and downside volatility. But this number of 17.1 for the S&P 500 can be compared to the 16.9 for the portfolio 2. And what we would know is that portfolio 2 is almost the same. A little bit less volatility, but it's just a little bit. And so you were able to add $2.2 million without taking any more risk in terms of volatility. Now, there are lots of other kinds of risk, but for the point right now, let's just look at this standard deviation. Now, when we go to portfolio 3, when we add the small cap blend, again, another 10%. So now you're 10% small cap blend, 10% large cap value, 80% S&P 500. And now the return is not 11.1, but 11.2. 0.1%. Look what it added. Almost about $1.8 million. That small, what appears to be a very small additional return is a big deal, if not to you, to your heirs, let's say. And the standard deviation is, again, right in the ballpark with these other portfolios. So we would believe that with that small amount of small cap blend and that small amount of large cap value, you have really not taken any significant additional risk. Then we add small cap value. Remember the gold ring. Well, because it's the gold ring, it may not shock you to find out that by adding 10% in this asset class, that it then moves from 11.2 to 11.5. It is a big deal. You have gone from $33.9 million to $40.2 million from that original $100,000. And you now have almost $4 million more than what the S&P 500 got on its own. And please note that the standard deviation is still the same. Now, we know that small cap value is more risky. Small cap blend, large cap value, they are all more risky than the S&P 500. But this is not so different than when you are building a portfolio of 500 companies. You're putting big, less risky companies together with some companies that are much, much smaller. They may not be tiny. They may be big companies, but they're small compared to Microsoft or NVIDIA or somebody. And so you are taking advantage of the same value of the diversification within the S&P 500. But we now have more than 500 companies, probably a couple thousand, maybe more. And we have talked many times about the four-fund strategy. Well, this is the four-fund strategy, except the four-fund strategy we know is 25% each in these four different equity asset classes. And we'll see that return in just a few minutes. Now, the addition of REITs. What we were told, what I heard when I went through the initiation, the instruction from dimensional funds, from the academic community, what they told us was that REITs would probably make about the same return, at least they had, as the S&P 500. And that what you were really getting by adding REITs is an equity asset class that has a return that is similar to the S&P 500 historically, but it is not correlated. It doesn't move up and down like the S&P 500. Now, sometimes it does, of course, but there are lots of times when the REITs are doing the opposite, if you will, from the S&P 500. And so when you put it in the portfolio, it isn't there. They said, don't expect to make more money, but it should reduce the volatility of the portfolio. Well, and in fact, it does. The standard deviation falls to 16.8. And this is the first year since 1995 that I have made this presentation that the number at the end of the period of time was lower than the four-fund portfolio. You made about $220-some thousand less by adding the REITs. But it did bring down the volatility. And then, in one fell swoop, we take these four international equity asset classes down here, and we put them together as 140% position. So 10% each, international large cap blend, international large cap value, international small cap blend, and international small cap value. And now you have 9 different equity asset classes, and the compound rate of return is now 11.8%. What in essence just happened is that each one of those international equity asset classes, each one of them added approximately 0.75% so that with the addition of those four, you go from 11.5 to 11.8. So you're up almost 1% from the original 10.9%. And you are now up to almost $17 million from the $29.9 million you started with the S&P 500 for a total of $46.8 million. But there's more, because we're going to add the emerging markets. And of course, emerging markets is one that is really volatile. Spends a lot of time at the top, a lot of time at the bottom when you look at the returns over decades. But over the whole period of time, because it is so volatile and because it does its own thing, and so in the rebalancing process, it can be really helpful. It takes the return to 12.1%. It takes the dollar return to $53.4 million. And yes, it also takes the standard deviation up about 1%, which is a very small increase. So when I saw this, and I realized that every time I took I added a baby step. I added an asset class. I was adding more companies. I was adding equity asset classes that as a group had paid a good premium. Remember, when they talk about premiums in the equity market, the first place they compare to is the fixed income. And all of these equity asset classes are historically way above that of bonds. So my hope was that this would give people who would take the risk of these other asset classes a sense that because they're only a small piece of the whole, that it is a risk worth taking. What, of course, I know, and you know, if you've tried to do it, it's a lot of work to manage a portfolio of 10 different equity asset classes, particularly if you add fixed income asset classes as well. But there is one other good lesson on this page, and that is the table that's the box here in the middle. It's the same strategy. You start with the S&P 500 and you add in 10% increments. The difference is this. In the table at the top, it was rebalanced annually. In the table in the middle, it is rebalanced monthly. Well, when you rebalance monthly, it means that the better returns of the more risky equity asset classes are going to gravitate very quickly to the lower producing asset classes. So you're going to spend less time accumulating wealth because you're taking the best producing equity asset classes, you're taking their excess profit and giving it to those that are producing less. Now, I don't know if this is a life-changing difference to you, but I can tell you at the end of that 55-year period that the one ended up with the annual rebalancing strategy ended up with 53,439,676 versus 47,923,359 for the monthly rebalancing. So it is our belief that the more often you rebalance, not only is it a lot more work, but it is also going to lead, in most cases, to a lower return. But it probably won't shock you to find out that it also led to a lower standard deviation, 17.4 for portfolio 7 versus 18.2 for the annual rebalancing in the same portfolio. So we have spent historically most of our time talking about this 50-50 combination. And in fact, it's probably, the reality is that most people don't have 50-50. I happen to have 50-50 because the whole idea was not to play favorites with what were perceived as equity asset classes that would perform well over the long term. Well, what we know recently is the U.S., and there's a whole bunch of reasons, whether it's the strong dollar or our advantages in technology, whatever they might be, they have served U.S. shareholders well. Now, I expect you've got what we're trying to show here with this table. The thing that's important to me, and I think has made a huge difference in what we can do for you, is that it was this portfolio that from 2012, when I retired, until Chris Pedersen joined our foundation, and Daryl had joined our foundation by, I think, 2014, and Chris in 2016. And they said, along with others, that 10 different equity asset classes was too much. Now, of course, I was really only trying to show the implications of using all of these. I didn't mean to suggest you had to use all of these, but what we hadn't done is the research to find out how could you build different combinations that would then require fewer of these asset classes, but still give us the same exposure to large and small and value and growth. And then, of course, US and international. And Chris took on the project. And I think what he came up with is absolutely wonderful because, as you will see as I go to the next table, it is not a table about the 10 equity asset classes. It is a whole bunch of different ways that you can put these asset classes to work. So as we look over here at the far left, we see the S&P 500. That we call portfolio one. It isn't that we recommend it as a portfolio, but we do know that that is what a lot of people have decided, either the S&P 500 or the total market index. That's their equity exposure. But next to it, you can see the ultimate buy and hold worldwide. It's just what I've been talking about for a half an hour, and that is the combination of all of those different equity asset classes. That shows the same thing as we saw before, that the S&P 500 grew to almost 30 million on the $100,000 investment in 1970, and in the ultimate buy and hold over 53 million. And here's where the great work of Chris and Daryl and all the work they did to simplify and still give us a shot at getting a higher rate of return using exclusively these equity asset classes that the academics had blessed. But it didn't mean we had to use them all. And so when you look, for example, at the worldwide four-fund strategy, and if you went down to the bottom of that page and you looked at what the worldwide four-fund strategy is, it's 25% S&P 500, 25% small cap value, US, 25% international large cap value, and 25% international small blend. So basically, with the exception of emerging markets and the REIT, it was the same exposure percentage-wise to large and small and value and growth. It was basically the same thing. And what we find out is the return over that 55 years in this table was almost exactly the same as the ultimate buy and hold. And when you look then at the next column, the US four-fund strategy, you'll notice it too is about the same. And what does it have? It has 25% S&P 500, 25% large cap US value, 25% small cap blend, 25% small cap value. It's the same combination of exposure to equity, but the total value, 56,500,000. Almost the same as the worldwide four-fund. Now, it does get different if you look at the worldwide all value. That's some US and international. The compound rate of return goes up more, but remember, historically, value has done better than blend. So if you expose all of your money to value all of the time, you would have had a considerably higher total return in terms of dollars, about 76 million, and a compound rate of return of 12.8. But boy, that doesn't mean that strategy is for you. And the reason it might not be for you is that that strategy, all value, is getting rid of the diversification of growth in the portfolio. And it means there are times long periods of time that you're going to be kind of out of sync with the market and scratching your head asking, have I made a big mistake? And then if we go all the way over to the two fund strategy, that's half in the S&P 500, half in small cap value. It grows to 67 million. Now, that doesn't mean we're going to get the same thing the next 55 years. How can we possibly know? But I suspect that all of these combinations will give a return that will be higher than the S&P 500. Maybe not by much, and maybe not at all. We can't know. But I do believe that creating more diversification, as those of you who remember our quilt charts, and we're going to be talking about the quilt charts in a couple of weeks, showed that by adding four equity asset classes instead of one, reduced the volatility substantially. Now, here again, we have on table A2A, we show the same combinations, but with monthly rebalancing instead of annual, and instead of 60 million, 67 million in the two fund strategy, it's 64.7 million. And you can take the time, I hope you will, to dig into these. Now, let me just say something very important here. I'm hoping that you will use one of these portfolios for some part of your portfolio, of your total portfolio. It may only be for your Roth IRA. It may be for your tax, whatever it might be. I'm hoping somewhere some of these things will fit into what you're building for the long term. But I do think that it is important to know more than what you see right here. So before you go making a choice, we've already recorded it, and we'll have a link to it in the notes, and that is to the sound investing portfolios that show the return by decade, show the returns by years, show the best of years, the worst of years, the standard deviation, the Sharpe ratio, the Sortino ratio on all of these different portfolios. They are all important things for you to know as you consider what's right for me. So now we've looked at a 50-50 stocks, US and international. No bonds. No bonds is going to, the addition of bonds is going to come up in a few weeks. We'll get there. That'll be the fine-tuning your asset allocation in terms of how much you should have in bonds. But right now, we're equities all the time. But now I want to look at just a slightly different combination, and maybe more like the combination that you would have some sense of comfort with, and that is table A1B. And for those of you who are listening to this as a podcast, we'll of course have links to these tables for you. But in this particular case, instead of 50-50, it's 70% US and 30% international. And you will see, if you sit down and compare table A1B with the table we just looked at a few minutes ago, table A1A, you will see there are some differences, not as great as you might think. Now, I think you'll see some bigger differences when we look at the individual portfolios. But here in the ultimate buy and hold portfolio, if we just go to the portfolio 7 that takes into consideration all of those 10% positions, but when in international only 30% instead of 50, notice in portfolio 7, which includes the emerging market, that there's 53,487,000. If we go back a couple of slides, we will see it was 53,439,000. So the differences are not great. You will see differences in a few minutes when you look at the individual portfolios. So if you're going all the way across the board, having all 10, it isn't going to, at least based on the past, be much different than what we know from the 50-50. But as we move to the individual portfolios, there are some differences, considerable differences. Let's just look for a second. I'm not going to go through them all. These tables are for you to go over and study in whatever depth you want to understand this information. But I want you to look, let's say, at the worldwide four-fund strategy. Notice the $100,000 investment in 1970 with a 70-30 U.S. international portfolio grew to 64 million. On table 2A, it was 57 million. So that is a substantial difference. If we look at the table A2A 50-50 for the worldwide all value, you had about 76 million at the end of that period. With the 70-30 break, it was 82 million. So what does this say? It says that particularly in the value area, there was a really substantial advantage over that period of time to be overweighted to U.S. So, and by the way, we don't have tables for 60-40 or 80-20 but I think that you'll get a feeling for that as you look at the differences between these two tables. For example, if you wanted to figure out what 60-40 looked like, you could look at the 50-50 and the 70-30 and know that it's somewhere in between. It's not very complex. And again, by the way, at the 70-30 level, as we look at table A to B, and we look at the, for example, the two-fund strategy over that period of time, well, that wouldn't make any difference whether it was 50-50 or 70-30 because that's an all U.S. It has to be something that's a combination. But if we look at the worldwide all value annual rebalancing, $82 million approximately. If we look at that same portfolio with monthly rebalancing, $75.6 million, that's a substantial difference. And interestingly enough, in that particular case, this is not always going to be true. The idea that by rebalancing more often, that the volatility is going to be lower. Here's a case where the volatility with rebalancing monthly turned out to be even higher. So almost no rule that you make for investing. It's like we say, there is a premium for being in stocks over bonds. Well, there are lots of relatively long periods of time where that just simply isn't so. So there you go. This hopefully inspires you to take the time to go listen or watch, and I think watching will be better, the piece that we did on the sound investing portfolios. And I hope that this gives you greater not only understanding, but confidence that by combining different equity asset classes, that it is just as important as having lots of stocks in your portfolio. Because as I look at the S&P 500, $100,000 growing into almost 30 million, And I see that every combination, whether it's simply adding small cap value or adding the three other major US equity portfolios, in all cases, the returns long term were significantly higher. I just can't stamp the word guarantee on it. I know you wish I could. By the way, I wish I could as well. So thanks for listening and watching. I hope you'll share this information with friends and relatives and folks that you think it would be worthwhile to learn more about this whole area of diversification. And thank you for watching.